Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and the hype right to the heart of the big issues of the day. This week, I'm delighted to say we're diving into the 2026 edition of the Global Investment Returns Yearbook. Each year, this research, compiled by Professor Paul Marsh and Dr. Mike Staunton of London Business School, together with Professor Elroy Dimpson of Cambridge University, provides an invaluable foundation for understanding the long-term evolution of global financial markets. UBS proudly supports this authoritative reference, which remains highly relevant for UBS staff, the bank's clients, and the broader investment community. With data stretching back all the way to 1900, the yearbook offers a unique record of real returns across equities, bonds, bills, currencies, and now gold, helping investors place today's market developments in historical context, offering essential perspective on diversification, asset allocation, and the enduring principle of risk and reward. More on that later. This year's edition is especially timely, with the 2026 yearbook expanding its analysis in several areas highly relevant to today's market debates. New research examines whether waves of technological innovation, including rapid advances in AI, have historically led to bubbles, and how such cycles have ultimately affected long-term returns. Here, once again, to guide us through are Paul Marsh, Emeritus Professor of Finance at London Business School, and our friend and another regular voice on the show, Kiran Ganesh, Head of Investment Communications in the UBS Global Wealth Management CIO. Kiran, Paul, it's fantastic to chat to you both, and it's always a really interesting time of year, actually, when we reflect on the Global Investment Returns Yearbook, the 2026 edition. And Kiran, before we pile into the findings, just remind us, fit this into the context of all of the fascinating publications and reports that UBS publishes. What's this one all about, and why is it always such a compelling read?
Well, I think what's really exciting about this one is it gives us an opportunity to zoom out from the day-to-day, which often preoccupies investors' attention, and really focus on what we can learn from the full span of market history. And we're really happy to partner with London Business School and University of Cambridge and then the professors to present this study, which is really industry-leading.
Well, yeah, and this year's edition, I guess, is especially timely. In the 2026 yearbook, it's further expanded its analysis. Regular listeners, Paul, will probably recall some of the scope from previous iterations, but just tell us a little bit about, what are the frameworks? What's the scope? How have you made changes for the 26 edition?
The yearbook covers stocks, bonds, bills, inflation, returns for 35 markets and 5 composite indices since 1900. So it's pretty extensive in its scope. And one of the things we obviously do every year is we update all of our analysis. But we've added a few new bits this year, and we've had a look at risk in a bit more detail, and including and embracing geopolitical risk. We've looked at gold, which was an outstanding performer last year. We've looked at the issue of whether or not new technologies like AI lead to bubbles. And we've also been doing some work on hedging. So there are some new angles, but the core of the yearbook is still what long-run returns can teach us about the future.
Well, yeah, it's fascinating, isn't it, to look at those big sweeping changes because you've got such an amazing perspective. And I guess to kind of kick off our discussion about findings, I suppose an obvious place to start is that whether we're talking about specific markets or just the whole shape of the global economy, it has transformed in an almost unknowable number of ways since 1900, Paul. I guess that's kind of stating the obvious, but that is a seemingly sensible place to start.
Yes, absolutely. I mean, back in 1900, the US was 15% of the global market by capitalization. Today, it's a dominant 62%. You look at the industries that were quoted on the equity markets back in 1900, and you look at them 126 years later, they're kind of unrecognizable. Today's industries weren't dreamt of 126 years ago. And 126 years ago, there were a whole bunch of industries which are tiny today because they've actually been overtaken by other technologies. So there's been a huge transformation in markets and in industries.
Well, yeah, and just on that, and maybe I'll throw this to both of you, this idea of how you make sense, using the data of the changing nature of some of these sectors. If we think about current hot narratives, technological innovation or the fourth industrial revolution, I suppose it's just hugely helpful to set that into such a much more sweeping historical context. Kiran, what does it mean taking this much longer view when you're talking about something that we usually discuss as being so current, so topical as, say, is there an AI bubble, or, are tech stocks overvalued? I guess having this longer view helps to put that in a really important context.
Yeah, for sure. I think investors are very fond of saying that things are unprecedented or we've never seen this before. But, often we've seen something similar, at least before, of, new technologies coming in and causing some disruption, or certain industries being very dominant parts of the equity market. So these topics that preoccupy investors today with respect to technology have often happened before. And I think also the great thing about looking at this span of history is it also allows us to analyze, what happened afterwards to those industries, because I think there is a sort of tendency to assume a certain mean reversion. I think people often look at these charts of saying, okay, well, this industry was big at this point in time and then it shrunk, and then this other industry came in and then it shrunk. But I think the important distinction that we made in the yearbook this year was to sort of disaggregate a bit, okay, well, what happens to the relative size of the industry, but what does it also mean for the returns for investors who had been invested at the time? And I think there's a difference there, which I think was actually really interesting in the study this year.
Back in 1900, if you looked at the US market, 63% of the value of the US market was in railroads. If you look at the US market today, about 42% is in technology. So concentration of industry, both then and now, but very, very different. And the ultimate declining industry was railroads. It went from 63% of the US market to well under 1% of the US market today. It's interesting that you can look at a declining industry like rail that was well established. It was not a new technology in 1900. It was sort of 75 years old. The Stockton and Darlington Railway started in 1825. But despite everything, US railroads beat the US market from 1900 to the present. And they also beat the competitors that came in and stole a large part of their market. So they beat trucking and they beat airlines. And so you can have declining industries that do really well. You can also have new industries like technology, which form a bubble. And everybody knows about the dot-com bubble and how serious it was. But if you had kept the faith with technology, you would have made excellent returns. And if you had just sort of invested through the bubble, bit your tongue, whatever, and even if you had invested right at the top of the dot-com bubble, you would still be doing better than the US market as a whole today if you'd kept the faith. People think, they look at the dot-com bubble, they say that new technologies result in bubbles. Some have, some haven't. And when you go back over history, the yearbook shows you lots of examples where new technologies have not formed bubbles. But even when they have, sometimes investors have managed to do very well in the long run.
Well, next, let's talk a little about risk and return, because one thing that's quite arresting in the report is this sort of relative outperformance of stocks, compared to equities, outperforming the other things, Paul, that you mentioned, bonds, bills, and so forth. I guess that's to be expected. Is it to a degree? But tell me a little bit about that outperformance, because it's quite consistent, isn't it, actually, since 1900?
Yes, consistent might not be quite the right word, because there's been a huge amount of variability. But when you look at risky assets, investors tend to be risk averse, and therefore they're likely to price them in a way that produces a premium for investing in them, a reward for the risk. And over the very long run, that's what you would hope to find when you look at the different asset classes. So equities are the riskiest asset class, and they've given the highest return. Bonds are the next riskiest. We look in particular in the yearbook at sovereign bonds, long-term sovereign bonds, but we do also look at corporate bonds. But long-term sovereign bonds are also risky in real terms, at any rate, but they're less risky than stocks, and they've given an intermediate return. And if you look at cash, which is about the safest asset, that's given the worst return. So there has been a law of risk and return. And it is as if investors price things beforehand on average in order to give them a risk premium for the degree of risk involved. So not entirely surprising, but because there's risk, you get a lot of variability over time as well.
Well, and to interrogate that idea of risk here, and tell me a little bit about what these data points tell us about, I guess, the nature of economic risk, because the data supports the idea that that's actually more significant over any time frame, really, than geopolitical risk. And yet again, I guess casual observers from the outside would be forgiven for thinking that geopolitical volatility and risk is the only conversation in town, say, at the moment, where we're in this state of flux. But it's important that to come back to that point about economic risk actually is more of a critical fundamental.
Yes, absolutely. And I think it was interesting to see in the study that there's been so many episodes of rising geopolitical risk through history, but actually the explanatory power of those rising risks with subsequent returns is actually pretty weak. So it was kind of very interesting to see. That said, there have, of course, been some episodes where geopolitical risks have morphed into bigger risks, which have also impacted the economy. World War I and World War II were very obvious examples. So I think there were, very clear distinction between geopolitical risk and economic risk when it came to seeing what really drives a market downside. And of course, that's particularly relevant today when we're sort of analysing geopolitical risk in the present. And really the key question for us today is, to what extent will this turn into a threat which leads to a global economic downturn?
Yeah, and we often talk about mitigating these kinds of risks through diversification as one critical lever. And Paul, just to come back to you, it struck me as quite interesting that the report makes this point about the effectiveness of diversification, and yet it becoming more challenging. Perhaps tell us a little bit about that.
It is a little bit more challenging. I don't think it's critical, and it certainly doesn't impact the broad message that investors should diversify. They should diversify across stocks, they should diversify across countries, they should diversify across asset classes. But markets have become more concentrated around the world. It's especially obvious in the United States, which is now at its most concentrated. If you measure it just in terms of the proportion of the market accounted for by the largest 10 stocks, the US market is now at its most concentrated for 100 years. And when you have value concentrated into relatively few stocks, it does make it harder for both active and passive investors, because whether you are in those stocks or not makes a large difference to your portfolio performance. So diversification is more challenging, and also because markets have become more globalized over time, and then the correlations between markets have risen, and that also reduces some of the benefits of diversification. Despite all of that, the basic principle of diversification, it's really about the only free lunch you get in markets, that you can diversify, you can reduce risk, and if you can reduce risk by diversification, you can also increase return by gearing up that lower risk position to where you were before. And so risk and return are in that sense interchangeable.
I'm always in the market for a free lunch, Paul. Let there be no doubt. Yeah. Let there be no doubt about that. Kiran, it's funny. Long term is always interesting, and we have frequently on this program discussed the role of inflation over that long term time horizon. And there's some really interesting takeaways, aren't there? As there are in each edition, actually, about inflation, but this GIRI is no different. What does it tell us about the role, particularly in that with that longer term lens, that inflation plays here?
Yes, I think it's become more topical lately, in part because of the experience of 2022 and the very elevated period of inflation, and also today when a lot of investors are thinking about, what might happen if governments run up huge amounts of debt, or central banks are kind of pushed into cutting interest rates more than they would otherwise, and that leads to a higher inflation environment. So I think certainly a kind of hot topic for investors today. I think it's often sort of thought about that cash and bonds are very negatively affected by inflation, but equities provide something of a hedge. And I think looking at the span of history, it paints a bit more of a nuanced picture. So, we see that actually equities perform better in environments of lower inflation. They appreciate the macroeconomic stability that usually comes alongside with. So equities do actually perform better during low inflation environments. However, equities do also tend to outperform bonds during periods of high inflation. So I think if we're looking forward and thinking about, well, what might happen in an environment of higher inflation, we should probably expect to see weaker returns for both equities and bonds, but equities would still do relatively better.
Yeah, and another sort of longer term snapshot that I thought was interesting was about the relative performance of developed and emerging markets, Paul. And I think there's an important caveat, certainly in the summary of the piece, which is that obviously over such a long time frame, you have emerging markets that are effectively developed markets after a given time period. I don't know, the journey that, say, Japan has been on throughout over a number of decades. But are there still some interesting takeaways in terms of challenging some of the assumptions? I mean, people tend to generally associate EMs with greater growth opportunities. Does that hold true with this long-term lens?
With a long-term lens, emerging markets have actually underperformed. And you're quite right. You have to work out back in history what at the time were emerging and what at the time were developed, because Japan is clearly a developed market today, but was an emerging market back in 1900. Go back far enough, you could even describe the US as an emerging market. So you have to be very careful about that. But we've tried to be careful, and we have a definition for going back in time to define emerging and developed markets. And over the very long run, emerging markets have done worse. But the performance difference was really back in the 1940s. And since about 1950, 1960, emerging markets have beaten developed markets. Not by a huge margin, but by a little bit. And that's probably what you'd expect. If you hold a diversified portfolio of emerging markets, it's slightly riskier than a diversified portfolio of developed markets. And so you might expect a return premium from that. But it's been quite modest, and the difference between the two is not as high as you might expect.
Yeah, I think to build on that, it comes back to some of what we were talking about geopolitics and diversification earlier, that, while on a kind of overall global level has tended to be, economic risk, which has been probably more important than geopolitical risk at the driving market returns. At a very local level, there have, of course, been different episodes where geopolitical or political risk has led to an almost total wipeout of investors' wealth. And I think that's contributed to that weakness during some of the periods for emerging markets. So I think really speaking to the importance of diversifying across a range of markets to help mitigate against some of those local political and geopolitical risks, which can be extremely severe.
Yeah, I mean, if you go back to 1900, Russia was classified as an emerging market then. It's still classified today as an emerging market to the extent that people classify it at all at the moment. But you lost all your money if you had invested in Russian shares in 1917. And similarly, you would have lost your money in China in the late 1940s. So individual emerging markets have contributed to this picture of long-term underperformance of emerging markets. And those were definitely geopolitical, or rather they were political, they were domestic political risks. So emerging markets have been more prone to those kinds of risks. And that is one of the things that shows up in the data.
Just to zoom out a little, and Paul Marsh, I hope you'll forgive me for sort of interrogating you about this, as I think I've done on previous editions. But obviously, your work here with Elroy Dimpson, with Mike Staunton as well, to gather and scrutinise all this incredibly varied data set. So I'm sure our listeners will find, as I do it, fascinating to just understand what are some of the mechanics of that. Obviously, in an ever more digitalised world, there's ever more sources of information. But you're going back to 1900, so you're de-archiving huge ranges of often highly complex figures. Just remind us a little bit about some of the nuts and bolts of actually what you and your colleagues do to actually draw all of this stuff together.
Yes, this is not the three of us working alone. There's a network of academics internationally, and many of them are interested in financial history. And so we use their work, especially when it's been through the refereeing process of top journals, to document the histories of other countries. Where that fails, we've often rolled up our sleeves, and in particular, Mike Staunton is our big data man. And Mike has spent a lot of time in dusty libraries going over archived data. So there's an element of that, but we're also, to some extent, relying on academic colleagues around the world. And it was really the internet that kind of made this possible, that we could reach out to colleagues very quickly and exchange data and ideas with them, that caused the yearbook to first emerge around about the year 2000.
And Kiran, tell me that from your point of view. I guess once you get a yearbook, you get this sort of dossier, it drops, whether digitally or literally or metaphorically, on your doormat. It must just be really exciting, right? Because it's going to add the extra layer of understanding and another crucial sort of layer of authority to the work that you and your colleagues can do every day and the advice you can give to clients, presumably.
Yes, absolutely. And I think to build on what Paul was saying, I mean, I think the breadth of this data through history and the work that's been done to make it consistent and comparable is really something which is unsurpassed. I think even in this age of data and AI, and we've got instant access to all kinds of price information, we are often still a bit limited in terms of market history by what index providers have put together, or by certain countries which have slightly longer sort of data sets which are publicly available, like the US, for example. So I think the fantastic thing about this study is that it really has done the work to look across a whole range of countries, done the work to consider things about like what would an emerging market have been at that point in time, what would a developed market have been at that point in time. And it's not just for equities as well, and the professors have looked across other asset classes as well. So I think really provides a lot more robustness to our investment thinking, where sometimes you can think that perhaps the notion that equities do well over the long term is just a function of the fact that the US has done quite well. Well, this study shows that no, actually, it's held true across a whole range of countries. So I think there are things like that which we can take a lot more confidence in our assumptions because of the work that's been done here.
Just to butt in quickly on that, a lot of people think that the long run is 20 years. Some might call it 30 years. The trouble is, if you look over 20 or 30 years, you can't really say very much about risk and return in capital markets. That's because markets are so volatile. And that's why you really do need these very long periods of time. Very good data everywhere for the last 20 years, but that isn't the long run. You need to go back a long way before you can say anything, remotely statistically significant about risk and return.
The brilliant Professor Paul Marsh, and before that, Kiran Ganesh, bringing us to the end of this edition of the show here on Monocle Radio. You can listen again and explore at monocle.com, and do be sure to find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.